Good morning and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Thursday, April 23rd, 2020. We are pre-recording this Trading Places Live. Currently, futures are pointing to a mostly flat open, following the lead in Europe, which is flat this morning as well. What we're going to do today, I'm going to go through a few things with you. First, we'll kick off with the daily market recap, as we always do. Talking technically, I'm going to bring up a 60-minute chart on the S&P 500. Haven't talked too much about patterns of late because the market's been so crazy, but 60-minute chart does show possible head and shoulder top, but of course you need confirmation of that on a breakdown. We'll look at that. I'm going to go into scooter reports today. Scooters are probably one of the most, I don't know if they're one of the most used, it might be one of the most overlooked features at StockCharts. I find the scooters extremely helpful to give you a very quick and dirty assessment of relative strength, and we'll talk about that. Get into some earnings. Earnings season really beginning to kick in. A number of companies starting to report. Things will pick up here over the next week or two, with many of the S&P 500 companies having reported probably by the next, let's call it 2 weeks. And then upgrades and downgrades, got a few of those for you, and then we'll wrap up the show as we always do with the three you must see, three charts that I'm looking at as we go into today. A few, they might give you some ideas for trades, maybe just from an educational standpoint, but we'll finish off the show with that. So let's jump into the daily market recap. And first off, you can see that it was a good day yesterday. This was welcome relief because the market was starting to roll over, and with the Dow Jones, S&P, NASDAQ, mid cap, small cap, you can see all below. Now, this is a 10-day, 10-minute chart, but you can see even on the short term, these moving averages, we were below all of them, came back up and started trending above them. So we took a negative at the open and turned it into a positive, which was at least a good day for the bulls to kind of weather the short-term storm. The Dow finished up 2%, 456 points. The S&P up 2.25%. NASDAQ up nearly 3%. So the NASDAQ, which had been underperforming earlier this week, actually showed some leadership yesterday, which was good. Mid caps and small caps, though, both lagged a bit. Looking at the sectors, you can see technology having a strong day. This was the group that was really struggling the last couple of days. We had gone, I don't know, all the way back down. You can see the low back on April 13th and bounced off of that. So that was good news. Got overhead resistance still up close to 90, and that double bottom down there just below 84. So that's the trading range in the short term for technology. But the group was up almost 4% yesterday. And not only did it go up, it kept going up throughout the day. And when you look at the Dow and the S&P, not as much, at least on a relative basis. So technology performed well throughout the day, and that was a good sign. Energy also bounced a little bit. Finally, we got a little relief in terms of crude oil. We're seeing more relief this morning in terms of crude oil. Last time I looked, I think crude oil was up. It was up 12% this morning, back to $15.43 a barrel. Can't even believe I'm saying $15 a barrel. But still, it was up 12% this morning, so that may give some energy stocks another boost today. Utilities also up nicely yesterday, nearly 3%. Communication services and discretionary, two other aggressive groups joining technology, leading the market yesterday, so that was good as well. Let's move on to the 10-year Treasury yield. Now, later this morning, again, this is being pre-recorded, so later this morning, probably about 45 minutes or so, we will be getting the initial jobless claims, and this has been a headline number now for the last few weeks. Today, the market is expecting another big number. Initial jobless claims forecast right now, 4.25 million. I think last week was 5.2 million, and we've seen, I don't know, 15, 16 million the last 3 weeks. So let's keep an eye on this. If it's better than expected, I think that could give the market a lift, just because we've seen some other decent news in terms of the virus and the spread of the virus. So maybe if the market were to start anticipating that maybe things are starting to slow down a little bit in terms of the new claims being filed, I think that could be a good sign for the market. But let's see. We'll see what happens when it comes out and how the market reacts to it. March new home sales also will be out later today, and then tomorrow we'll have April consumer sentiment. That'll be an interesting report to follow, and then the very volatile durable goods for March will be out tomorrow as well. So still a lot of economic news and reports coming out later this week. And we've got a lot of earnings reports out as well. The impact on the Treasury yield, well, this doesn't show the current, but current last time I looked was right just about where we finished yesterday, 0.62%. So that looks to be flat as well, along with U.S. futures and what's going on, what we've been seeing over in Europe so far this morning. So everything seems to be pretty stable this morning. So we'll have to kind of follow along, see what happens to the 10-year Treasury yield after the initial jobless claims comes out later this morning. I think that will be a little bit of a clue. And just keep following along these. It seems like wherever we open on the yield, or wherever we start today, it seems like we finish higher. And that goes right along with my thinking that the stock market's being accumulated. So just like the treasuries are gapping up and then selling off, a lot of times we're seeing, well, the opposite of that is the yield, which a lot of times has been gapping lower and then rising throughout the day. But that's been coinciding with the stock market, which also since back in late February has had this tendency. If we see weakness, for the most part, it's been at the opening bell, and then we see accumulation. So that's kind of the same picture the 10-year Treasury yield is showing us here with all these hollow candles. But I still want to see a trend higher. I don't think stock market is going to have any hopes of continuing this push to the upside if the yield continues to drop, because it's just too much money going into treasuries to force the yield down. So that money going into treasuries, not going into equities. So it just becomes a problem for the equity market. Now, if we could get the 10-year Treasury yield to stabilize, even if it's right around this level, and then slowly start to move back to the upside, I think that could give the equity markets a lift. But if we continue going down, that's going to be a drag on equities. So let's move over to and talk a little bit about, in the Talking Technically segment, the S&P 500 net chart. I mentioned a possible head and shoulders top. Got to kind of look at it. I don't know. It's not crystal clear, but if we annotate it here, let me show you what I'm seeing. So right here, coming across, that would be a neckline. If I can finish it there, hold on. Now it's not wanting to annotate here very well, but there you kind of get the picture. There's the neckline, left side of the neckline, right side of the neckline. So before that, you need a left shoulder. This would be your left shoulder. So just type this in here. All right, that's a little big. So we put in the left shoulder over here. And then, of course, we have the head, which you need another higher high, which we have here. So there's left shoulder, neckline. We come up, finally put in that head. And then the next time we come down to that neckline down here, we establish that right side, which is almost even. And now, is this a right shoulder coming up? And that, certainly could be argued. I don't, the one thing I'll say about any bearish pattern, any pattern in bearish or bullish, you have to have confirmation. So this isn't a topping pattern unless we get the breakdown. And even if we get the breakdown, this isn't exactly a huge, when we start measuring from the head all the way down to the neckline here, we're talking about maybe, what is that, 2,900 down to 2,740. So 160 point, well, it's not even the 2,900. So it's maybe 2,870. So we're probably looking at 130 points or so. So if we break below 2,730, that would take us maybe back to this 2,600 level. And of course, that breakout that we had was right at about 2,630. So my guess is that if we break down, I would expect that we would test this price support level at 2,630, and the measurement of this head and shoulder, maybe on an intraday basis, maybe we see it go back down close to 2,600, maybe even down intraday to test, if we were to have a scary day, maybe down to test the gap support at about 2,570, 2,580. So that's what I'd be looking for if we break down. There's no guarantee that we break down. And again, that's going back to the pattern and what you look for. If you get the breakdown, then you've got a measurement. If you don't get the breakdown, there's nothing saying that this isn't just sideways consolidation before you make the breakout. So just because you see a head and shoulder pattern, don't jump to a conclusion that you're going lower. I've seen a lot of mistakes, especially in a bull market, a lot of mistakes being made in that regard. All right, let's keep moving on because I got a lot to go over here. I want to go over the scooter reports. So I want to talk a little bit about the scooter. And first off, a couple of things. If you go to your dashboard, if you haven't used this gear shift up here in the upper right-hand corner, it gives you different things. The reason you see all these different panels on my dashboard is that I've got all these checked. So I've got the additional data panels, scans and alerts, chart list panels, commentary, and so forth. You can uncheck these if you want. But if I just get rid of that, this is the additional data panels that come across. Now I've got scooter reports, large cap, mid cap, and small cap set up, but you can do a lot of things with these data panels. You can, have your market movers, sector summary. So I could switch this so that I could see right here on my, without having to go up in here and looking through the member tools, I could have the sector summary here. It's all in how you want to customize your own dashboard. But I like to use the scooter reports just to see what's moving, see if there's something happening that I'm not paying attention to, some tickers that I'm not aware of what's going on. And I usually, in a good market, I want to see what's going on in terms of up moves in scooters scores, and also down moves. A lot of times stocks that are pulling back, my strategy, I try to buy pullbacks more so than buy strength. I like to get strong stocks, but I like to get them in a pullback. So sometimes having the top down, showing you which stocks are showing a big move to the downside. Now, for me, when I look at it, if I see something like L Brands, LB, 4.6 on the scooter, went down 18. Well, quick math to me tells me it was at 22 yesterday. I'm probably not as interested in a stock that has a really low scooter score because I'm a momentum trader, short-term momentum trader. I trade on the long side and I want healthy stocks. But a stock like Biogen or PACCAR, PACCAR, ticker symbol PCAR. This was a scooter that was near 75 before yesterday. It fell back to 61. So that could be a stock that's just pulling back temporarily. MDT, I'm going to talk about in a little bit. Actually, I don't want to get into it now. That's one of my 3 you must see later in the show. But this one's down 12 from 75 or 76 to 63. So that's one way to just quickly identify some of the things that are going on in terms of relative strength, just based on what you see here on your dashboard. I don't want to get into the formula for the scooter. You can go to Chart School and look at that. But essentially, it's looking at what the market's been doing over the past 5 months or so, based on the formula. If you, if a stock's been doing well for the last 5 months, really well, then it's probably going to have a very strong scooter score. And scooters go from 0 to 100. You still have to, continue to follow it though, and maybe even take a look at the long-term picture, because I've seen some stocks that are in really bad long-term downtrends, but they have a 3, 4, 5 month period where they're bouncing and they look really good on their scooter. But then you go back and you look at a 10-year chart and you would never take a look at a chart like that because it's been going down for 10 years while the whole market's been going up. So you have to pay attention. Everything has its limitations, and the scooter certainly has its limitations, but it can provide you some absolutely great information. So let's take a look. Let me show you a little bit how I use the scooter. So one of the things that I would do, and I'm going to come back to this in just a minute, but let me go in. Let me just pull up a chart so I can get to my chart list. One of the things that I like to do is look at relative strength of industry groups. And if I hit the view all summary, and I do this a lot, so if you've been following the show, you're probably pretty familiar with this. But if you go back, let's just say the last 3 months, I can look to see what groups are leading the market over the last 3 months. Gold, I've talked about this, I'm not a huge fan of gold mining longer term. Short term, I think it's fine. When the market's fearful, this is a great area, and you can see it's been one of the best performers throughout this pandemic. They've been the 2 best performers throughout the pandemic. But I think once the market starts to stabilize and the VIX comes down, I would expect that these will start to fall in my list of best stocks. Probably, I don't know what it is on a 1 month basis. It's still up there even over the last month. The market's been pretty good over the last month, but the volatility index does still remain high. I think when that VIX drops, I think you're going to see a big change in the relationship there. But let's go back to the 3 months. I want to pull up some of these charts or give you some ideas on scooters, how you can find scooters. Now, broadline retail and specialty retail. This is the third best and fifth best industry group out of 104 industry groups over the last 3 months. Broadline retail, specialty retail. If you haven't been following this, you might not realize that. But if we go back to our dashboard and we go into the scooter reports down here, different way to look at scooters. You can bring these up based on large cap, mid cap, small cap, ETFs, industries, and then you've got Toronto, London, and India stocks. So you got a lot of different choices there. I'm going to go ahead and leave it large caps for now. And you can see that it's in scooter order, which tells me strongest to weakest, essentially. But let me type in broadline retail. And you can see there are the 3 stocks, large caps, that you could consider. And you can quickly identify Amazon's the strongest, Target's kind of in the middle of the pack, and then Macy's not so strong. And if you look at the charts, I think you'll probably see exactly what the scooter's telling you. Macy's went straight down, has struggled to bounce back even through $7. This was a stock that was at 16 2 months ago. And now it's almost back down at its low. The stock market, if you look at the S&P 500, has bounced up and is nowhere near its recent low. So just quickly eyeballing it, you can see Macy's is not a good performer. And when we look at the scooter, it quickly shows you. So even if you're not looking at the charts, the scooters can be very helpful for you to visualize maybe what's taking place in the market. Now, if I go on to Amazon, so we got Macy's doing horrible, but Amazon's doing great. Now, these are 2 different broadline retailers, but which one would you rather own? Hopefully it's Amazon. Got a great accumulation distribution. So even when we were going down, the accumulation distribution was starting to go up. So I think that you look at all these hollow candles, I think professionals were buying Amazon while everyone else was panicking out of it. And now you can see the result back to the upside. If we go back to Macy's, look at the accumulation distribution here. When prices were going down, so was the accumulation distribution, setting new lows. So it's hard to argue anyone's accumulating Macy's when the accumulation distribution is going down and the price has lost 75% of its value in 2 months. Completely different looks to 2 charts within the same industry group. But you can, again, just taking a look at the scooter. That's not what. There we go. So just taking a look at the scooters among the large caps tells you that Amazon 97.5, Macy's 0.8. I showed you the charts. But you don't really need the charts. You can simply look and get a pretty good idea of what's going on just by this. So taking a look at the next level. Now we go to mid-cap stocks, still in the broadline retail space. VIP shops, JD.com and Alibaba. Those are the 3. Throw in Ollie's. Those are maybe 4 you want to look at. I would, 3 below, down at 50 or below, I have no interest in. Go to small caps. If you like small caps, well, here's a stock. I'm not going to try to pronounce it, but GAIA. If we pull up the chart there, I haven't looked at this chart in a while. But on the way down, accumulation distribution never broke below the low. Now, as it moves back up, you can see accumulation distribution rising. So here's a stock, small caps. We know small caps haven't been particularly good, but here's a stock not too far from breaking out. Yesterday, traded up near $10. Back late February when the market was at a high, the stock was $10.50. So you can look at it here and see the relative strength, but you don't need to do that if you're looking strictly at the scooter scores. So it's just, again, another way to look at the market and quickly identify areas of the market that you like. That's where I had the individual industry groups relative to the S&P 500. That's what I use that for, to find the strongest groups quickly. And then I can go into the scooter reports, type in those groups, and it puts them in order, the scooter order for me. So, that was the broad line, but I could also do specialty retailers. And so here's your small caps. Here's your list of small caps. Now, that doesn't mean these stocks necessarily are great. This is relative to other small cap stocks. So if all small caps are going down, many of these stocks are going down, but they're going down less. They're being ranked higher. And then, of course, I could go mid-cap. Carvana, you can see easily one of the best mid-cap specialty retailers, and then large cap. Tiffany's 93.6, Dollar General 92. What do I stay away from? well, CarMax and Dollar Tree, based on this, are areas that I might want to be cautious. So just wanted to give you a quick analysis for those of you maybe who are new to the show or new to stock charts in general. This is a great tool to use. Definitely the Scooter Reports gives you a quick and dirty relative strength analysis of what's taking place in the market. All right, let's move on to earnings. Got a bunch of earnings. Let's start off with CSX. So CSX reported last night after the bell, and you can see the stock down. Accumulation distribution, though, not bad. Stock actually breaking out to a new 52-week high. So it's one of the better railroads in terms of its accumulation distribution, but I also like to make sure that it's good in terms of relative strength and relative to its railroad peers. You know, it started strengthening, weakened. It's kind of been middle of the road. So I wouldn't say it's one of the best. But they did come out. They beat bottom line $1 versus 92 cents. The stock at this point, I would just be watching maybe this gap support down here around 56.5. Breakout above 65 would be very bullish on CSX. So watch that trading range for now. As far as their reaction to earnings, we can give a quick update. Up about 1.82%, up $1.11, $62. So I think it's going to stay in that range that I was just talking about. It's got a lot of work to do to get out of the top end of this range or the bottom end. So look for more consolidation here in the near term for CSX. Lam Research. Let's take a look at what's going on after their earnings report. Stock down 1.39%. Had a huge day yesterday. Lam Research was up $26 yesterday, or $28 yesterday. So it looks like it's going to be down a little bit. They missed on their earnings, came in at 398 versus 402. So that was a little bit of a problem for Lam Research. Market didn't like it too much. Going back and looking at the chart. Let's look at that sharp chart. Looking at the chart here, I would say yesterday's low established a pretty important low and the recent high at 280. So trading range here, I'm going to call maybe 242, 243 to the downside, 280 top side. That's where I would look for more consolidation. A breakout above 280 would be very bullish, especially because it's in the semiconductor area. And the semiconductors had a pretty good day yesterday. I'll pull this up and just show you this. But you can see after breaking down below the 20-day, it immediately came back up and held it. And that's what you want to see from a bullish perspective. You don't want to see loss of two key moving averages and then continuing selling to the downside. So let's watch the low. And that was the reaction low over here in mid-April as well, April 13th. So I'd say 3,800 is going to be a pretty important level for semiconductors going forward. If you see that level start to give way, that could just add to any selling that we see in the overall market. Other companies reporting, another semiconductor reported last night is Xilinx, and this has been one that hasn't been as strong. If we go back and we look at the relative chart, you can see it's been beaten down versus the semis. I would say it needs to get above that relative high back in March to really begin to start to pick up steam. And when I go back and look at that accumulation distribution, it's been one of the weaker stocks in terms of that as well. Although it's been stabilizing, trying to come back up, but I think it's got work to do. Watch this gap resistance here around 92. Big volume there on the gap down and continuing selling. We failed there. Looked like intraday we had a breakout. See that tail coming up above that gap resistance, but failure on the close and failure at the 20-day, and we went back down. Now we're all the way back up here. This could be a bottoming head and shoulder. Reverse head and shoulder, left shoulder, neckline, head, back up here to put in maybe the neckline, a pull back to the 20-day, could be a right shoulder, and then ultimately a break above 92, especially if volume comes in. That could be a major signal for Xilinx going forward. Xilinx did beat on their bottom line, 78 cents versus 76, but still got some work to do there on the chart. This morning, Eli Lilly, got to pull this one up. Last one I'll show you here on earnings. Lilly has been a very strong performer within the pharmas, has broken out. Look at the accumulation distribution, very strong, and I don't even have to pull up relative strength. I can tell you this is a leader in the pharmas. So you now have pharmas leading the S&P, you have Lilly leading the pharmas, Lilly breaking out, and they came out with their earnings $1.75 versus $1.55. Great news there. I think if it were to pull back anywhere close to that 20-day moving average, I would really be a fan of Eli Lilly. So LLY this morning, it is up 99 cents. But maybe we'll get some selling now that the rumor has turned into news. So maybe some buying on the rumor and selling on the news. We'll see. I also want to point out Citrix. I guess I should show you one more real quick, because Citrix has been trading tremendously. It's been one of the best performers in the market. They crushed their earnings estimate. 173 versus 117. Stock has been huge. It is showing a negative divergence here, so watch for a reversing candle, because a lot of this is already built in to the price action. That a lot of the earnings that we're seeing today actually was already built in. Stock ran from 100 to 150 the last couple months while the market's been struggling. So negative divergence, news is out, watch for a reversal there. All right, upgrades and downgrades. I'm just going to give you a few of these before we get into the three you must see. CMG, I'll just pull up a chart here on CMG because this one's been very strong. They came out with their earnings yesterday, had a huge move up, massive volume. You can see that. Accumulation distribution's been powerful. CMG was upgraded today, no shocker there. Darden Restaurants, DRI, upgraded. GPS, PANW, TXRH, Texas Roadhouse, all of those upgraded. Downgrades, Apple downgraded today. Coupa Software downgraded. Paycom Software, Cisco, the food company, SYY, Twilio, and Zscaler, all downgraded. Many other companies downgraded. I'm just pointing out some of the companies that I happen to see. All right, let's move on to the three you must see. Let's wrap this thing up. We're going to start off with MDT. I mentioned this one earlier. MDT, a couple things I like about this. Number one, let's go over here to the relative strength. The stock itself has been going down and was middle of March was in a free fall on a relative basis, but it has picked up, started rolling over a little bit here, but it just hit a key support level. And I'm going to talk about that in just a second. But first, look at the medical equipment stocks. So medical equipment is an area where you want to be. So that just is, from a top down, starting at the S&P, looking at the sectors, looking at the industry groups. You got healthcare, then you've got medical equipment. This is a really good area of the market right now. MDT is part of it. And even though it's not one of the best stocks within the group, notice the pullback. It looked like it was breaking down below $95 support, and the 20-day moving average got as low as 93.72 and then reversed back up and closed above. So I think MDT, this is a key area of support now for the stock. I think I would even say the breakout around 92.50. I think that up to $95 is key support, but I'd be looking for it to head back to 102.50, and that is a critical area. If you get through 102.50, actually let's call it 103, 103.50, you get above that level and get some volume coming in, I think MDT would look really good. All right, two more real quick. Starbucks, just wanted to point out, look at the, I'm going to just show you the accumulation distribution on Starbucks off the charts. So a lot of hollow candles trending above its 20-day. I think Starbucks looks really good. And then the last one I wanted to point out is Fluor. And I wanted to show you the difference between the OBV and the accumulation distribution. So OBV is based strictly on where you close. That's a shooting star candle. OBV saw a big move up. Accumulation distribution, big move down because we closed at the low. I think this one pulls back maybe to that 20-day. Everybody have a great day. Be back next week. Happy trading.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.